Welcome to Taking Stock for the week ending the 28th of July 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome, Jace, with reporting season here. How are you thinking this will pan out?
Well, it's definitely been an interesting session, Kien. I mean, we've had US numbers come out last night, which we're going to talk about later on this episode, but it's going to be an interesting ride.
Yeah, just before we get started though, a quick yet important reminder, the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so any charts, tables we present shouldn't be relied upon as a guide for future performance. Well, Jace, our team of analysts are preparing for this reporting season, and it will be a crucial one for investors, especially with regards to outlook statements. The market shown in red is expected to generate earnings growth of around about 3% in financial year 24. But if we drill down into the individual sectors, we can really understand what's behind this number. And most sectors are expected to report positive earnings growth, as you can see. However, the growth of the market has been weighed down by negative expectations, and that's coming from the banks, the resources, which collectively contribute close to 40% of the index. So this growth is calculated using a market-weighted approach, but if we take the median or the average, then the average earnings growth rate for the market in financial year 24 is expected to be 12%.
Yeah, this is a really good chart, Kim. And I mean, it does sort of highlight where expectations lie. From our point of view, though, these expectations appear pretty optimistic, especially when you consider that we're in a contraction part of the economic cycle. The full impact of interest rate hikes has not really been felt yet. And only this week, the US Fed has decided to increase its US Fed funds rate by another 25 basis points. So it's definitely heating up in US cash rates. The largest threat that we do see in corporate earnings going forward is the elevated risk tied to global recession. If this does occur, then earnings expectations are likely to move lower. Since the start of this year, earnings expectations have fallen by around 5%, but historically speaking, the average decline in earnings during recessions tend to be closer to 20%, and this is highlighted in the table.
Yeah, that's a good table showing the historical changes to earnings when a recession occurs in the past. So have a look at that. But again, Jace, nothing is 100%. Only this week, data came out suggesting that the US economy grew by about 2% in the March quarter, while the International Monetary Fund upgraded its US GDP growth to 1.8% for financial year 23. But remember, all this is backward looking, so we need to separate the facts from the noise. There could potentially be further earnings downgrades to come over this reporting season. And we've already seen a deterioration in the financial health of the market over the last 2 years. And we believe more companies will become insolvent, especially across sectors in exploration mining, biotech, building construction, manufacturing, and retail. And you can keep track of the changes to the financial health of the stocks in your portfolio by using the change alerts under the alert manager in Stock Doctor.
And it's also vitally important to focus on risk management and perhaps play defense across your portfolios. And this includes being wary of having high exposure to high risk speculative businesses. Try to focus on companies that perform well in an inflationary environment, as well as maybe be beneficiaries of a rising interest rate environment as well. And these could include companies like insurers, AUB, Suncorp, or utilities and telcos like APA Group, Telstra, and Spark New Zealand.
Some of the key thematics as well is that you can position yourself across companies that have recently provided positive trading updates, and this could reduce your risk. And these include those in tech, like for instance, WiseTech, Technology One and Xero, who appear to be doing quite well in this environment. Then you've got travel stocks like Kelsian Group. They are performing quite well as well. And last but not least, have cash on the sidelines to help mitigate that volatility and allow for opportunities when the market is sold down. But turning our attention to some star stock highlights over the week, Star Growth Stock and Star Income Stock, Macquarie Group, they hosted their AGM. And while management did not quantify the group's first quarter 24 performance, their choice of language to describe the operational performance as substantially down outlines the softer trading conditions faced by Macquarie. And this includes subsiding volatility in gas and electricity prices, which reduces the trading income, and lower transactional deal activities, as well as the uncertain macroeconomic environment weighs on the market sentiment.
Yeah, investors did really hang on every word that management said, and there were many interpretations on what substantially down actually means. I mean, we've had a good discussion in the analyst room about this, but based on management's revised FY24 outlook statement for its global markets and commodities segment, which is otherwise known as CGM, this division deals with commodities income, and that is expected to go from up to broadly in line compared to FY23, which is definitely a change in terms of language. And this led to a 5% drop in the share price, despite consensus already anticipating flat earnings from this segment.
Yeah, very interesting, Jace. Overall, the market is projecting earnings to be about 13% lower for this financial year. But despite this, we believe that gross dividend yield of around 4.5% remains intact for now, given that it's not overly too high and appears sustainable and consistent with its historical levels. But moving towards another volatile sector, resource stocks have been releasing their quarterlies as well. And within the lithium space, both Pilbara Minerals and also Allkem, they delivered strong production volumes, but the result was marred by lower than expected lithium prices achieved in the June quarter.
It was definitely a roller coaster ride in terms of the lithium space this week, Kien. It's and from what we've seen, I think the volatility was on the back of China's first futures exchange for lithium, and that got off to a pretty shaking start in this week's worth of trading. Now, within the lithium space, you have to remember that thin volumes makes it more sensitive to small changes in data points.
Yeah, good fact there, Jace. And for those who are considering investing within this sector, it is also important to be mindful of the risks and also invest in the financially healthy businesses within this sector, because there are quite a lot of unhealthy businesses here. There is a tendency for these miners to have operational disruptions. And a good example of this came from Core Lithium. The code is CXO. They are a lithium miner who was sold down heavily over the week. Core Lithium is currently in marginal financial health and was the second most shorted stock on the ASX. So really keep track of all these risks that you can see on Stock Doctor.
Great. Thanks for that, Ken. And also over onto the corporate calendar, we're going to be hitting the ground running this reporting season. Start Income Stocks, Credit Corp and BWP Trust are expected to report their annual results next Tuesday and Wednesday, respectively. And also Star Growth Stock ResMed should report later by next Friday.
Yes, and let's not also forget the AGMs as well. And as management often provide insightful commentary, we've seen that from the likes of Macquarie Group earlier this week, but we've also got Computershare hosting the AGMs next Thursday. And now for Under the Microscope this week, we take a look at Star Income stock, Rio Tinto, which reported its first half results and is currently under review. Despite a solid performance in its iron ore division, volumes were weaker across the other metals. Additionally, lower commodity prices and higher costs resulted in underlying profits and dividends falling 30% year on year. And the interim dividend at US 1.77 cents per share fell short of analyst expectations.
That's right, Ken. It's also important for investors to understand that dividends for resource companies are highly uncertain, even though in this case, there is a wide number of analysts covering the stock. So certainty at 17 is perhaps not really certain at all when commodity prices tend to fluctuate. You can also see that from free cash flow is expected to decline this year as the company increases its capital expenditure to maintain and also replace aging mines in the Pilbara, as well as develop new projects in New Guinea, Mongolia, and also Australia.
Yeah, that's right, Jason. And that free cash flow also impacts the dividends. And the market was expecting a higher dividend, even though the payout ratio is at 50%. which appears to be in line with management guidance. And this suggests that the company may be looking to reinvest its funds for potential acquisitions. I know Rio Tinto, they just completed their acquisition of a copper miner, Turquoise Hill, in December 2023. And we suspect further M&A activity is on the cards as the company moves towards greener metals and achieve its net zero target.
From a balance sheet perspective, gearing remains quite low with a net debt to equity of around 9%. So Rio does have significant funding capacity for these future investments that you've just talked about, Kien. But one thing investors need to be cautious of is that Rio's reliance on iron ore. Roughly 80% of its first half 23 earnings were driven by this division. Hence, any weakness in the underlying commodity price will likely translate to significant changes in cash flows and also dividends.
Yeah, hopefully they can diversify this exposure in the future. But we noticed that the economic growth indicators and property data in China, they have underperformed expectations. And while there is hope for monetary stimulus to reignite their economy, we are cautious given that supply has been increasing from the major Australian miners as well as the Brazilian miner Vale. And this has led to lower future iron ore price assumptions and a 15% decline in earnings revisions over the last 3 months. Currently, Rio Tinto's gross dividend yield looks quite attractive at 7%. They are expected to go ex-dividend around the 10th of August. Ultimately, though, we must remember that mining companies are cyclical and therefore can provide investors with attractive income while commodity prices are high, but over the long term, these dividends are not sustainable.
Yeah, that's right. It's a very important point. And of course, we can't really talk about Rio without mentioning BHP Group as well, which has less of a reliance on iron ore at around 60% of profits. BHP has more focused approach to its assets as well, divesting its ownership of petroleum and certain coal mines to fund reinvestment into copper, iron ore, and also potash. We do view this favorably compared to Rio's underperforming aluminum division.
Yeah, interesting, Jace, but also notice that BHP appears to be on a slightly more attractive gross dividend yield at around 8%, with the ex-dividend date at the end of August. And with reporting season here, income investors might be wondering, what is the best way to monitor upcoming dividends? Well, Stock Doctor has a comprehensive range of tools to help income-seeking investors monitor their income and manage dividend distributions.
There is certainly a very, very wide spread of tools available to our Stock Doctor members, Kien. For those actually looking for upcoming payments, you can refer to the pending dividend section under Tools. From here, the companies are listed in chronological order from the next available dividend date. Stock Doctor also provides an estimate of the dividends per share as well.
And of course, another way to monitor those upcoming dividends is through the corporate calendar, where you can filter for event types such as ex-dividends.
That's right, Ken. And for those members wanting to run the dividends across a custom watch list or even companies from a desired portfolio, such as Star Income stocks, you can sort these companies out by ex-dividend dates as well, and also view other income fields such as franking, payout ratio, and also forecast dividend yield.
There's so many options here, Jason. Another option is to open up the alert manager and create a notification alert for days until ex-dividend or dividend payments.
And also as well, Ken, if you want to investigate a particular stock, then you can do this in the dividends tab as well. And from here, members can see further details, including a history of dividend payments and also any forecast metrics. Of course, you can also view this information under Golden Rule 2 and also Golden Rule 3 in our 9 Golden Rules screen.
And if you have any questions, feel free to contact our team of representatives. But Jace, that's all we have time for. Thanks for your insights today.
Thanks for having me, Kien.
And again, if you have any questions with today's episode, feel free to participate also in our Lincoln Live webinar this Monday, where Tim Lincoln and Matt Swartz and myself, and of course, Rob Manfrey will be there to help answer any questions you have. But to summarize, With the outlook for financial year 24 appearing overly optimistic, it is important to play defensive with your portfolio. Focus on those risk management and financially healthy businesses. Dividends across the resource stocks can be unreliable, so make sure you diversify your income across other more defensive companies as well. And use Stock Doctor's suite of tools, including the corporate calendar, alert manager, watch list, and dividend summary to help you keep track of your dividends or even financial health changes this reporting season. Have a happy, healthy, and prosperous week ahead.